So there is this new report from Guosheng Securities that's making a pretty bold, maybe even shocking prediction about where China's economy is headed. It's basically saying that after some really uncertain years, a massive shift is on its way. So what's the new playbook for investors? Well, let's break it down. The report kicks off with this line from a Mao Zedong poem. And this isn't just some poetic flair, It's a really powerful signal. It's saying that after all the difficult, deep changes, China's market is finally finding its footing on a new, more stable path forward. And this really gets to the heart of the problem for anyone watching China. The old playbook, the strategies that worked like magic during that incredible growth spurt, well, they just aren't cutting it anymore. So the huge question is, what's next? Okay, so here's the report's big, and for a lot of people, totally counterintuitive prediction. China's capital market is standing on the edge of a long-term bull market. Yeah, even with all the tough economic news we're hearing, the report argues for a sustained period of growth. So how on earth could that be possible? Well, the theory behind this bold claim comes from an idea called the Kondratiev wave, which is all about these super long-term economic cycles. The report says China is now entering what's called the depression phase. Now, I know that sounds awful, right? But in this model, it doesn't mean economic collapse. Instead, it's the moment a fast-growing country finally catches up, achieves industrial maturity, and closes that gap with the world's top economies. And historically, it's this exact phase that comes right before a major sustained market upswing. So what does this depression phase actually look like on the ground? Well, the report argues it all boils down to a classic supply and demand story. It's predicting a future where a huge amount of capital, basically money looking for a place to go, is going to be competing for a relatively stable number of assets. And basic economics tells us when more money chases fewer things, prices tend to go up. But where is all this money supposed to come from? Well, the report points to this massive engine driving the change, something it calls the five-fold capital surplus. It's a way of breaking down this coming flood of money into 5 completely different sources, which are all, for the first time, starting to flow in the same direction. Probably the best way to picture this is to imagine 5 giant rivers of money, each one starting from a different part of the economy, but they're all about to merge into one giant lake of capital. So let's take a look at each of these rivers to see where this potential investment flood is coming from. Okay, river number 1 is corporate surplus. And this year, 2024, a huge milestone was hit. For the first time ever, the amount of money Chinese A-share companies gave back to investors through dividends and buybacks was more than the amount they raised. This surplus, over 683 billion yuan, marked a major turning point. It means mature companies are now generating so much cash that the market is actually giving back more capital than it's taking in. The second river is the government surplus. For decades, China was borrowing like crazy to build all that infrastructure. Now, that phase is winding down, and the focus is shifting to paying back that debt. And to make paying back debt easier, you want to keep interest rates low. That, in turn, floods the financial system with liquidity, or what you might just call cheap money. Our third river flows from institutional surplus. So think about big players like insurance companies and pension funds. With interest rates dropping, the returns they get from their usual safe bet, government bonds, are just shrinking. To hit their targets, they're being forced to rebalance their portfolios, and that means moving huge sums of money out of those low-yield bonds and into equities, all in the search for better returns. Now, the fourth river, and this one might be the biggest, is household surplus. For a whole generation, the main way Chinese families saved and built wealth was real estate. But as that market cools down, all of that household wealth needs to find a new home. And where's the logical place for it to go? Financial assets, and more specifically, the stock market. And finally, our fifth river, foreign surplus. Right now, there's a pretty big imbalance in how the world invests. The U.S. makes up about a quarter of the world's GDP, but some international funds have more than half of their money invested there. The report's argument is that as the global economy keeps rebalancing, a natural correction is bound to happen. And even a small shift of that over-allocated capital towards other markets, like China, would mean a massive inflow of new money. Okay, so we've got these 5 powerful rivers of capital, all flowing toward the same place, potentially creating a long-term bull market. That's the what. But here's the really crucial so what. How does this change the way you actually need to think about investing? The huge shift that's needed is moving from being a momentum chaser to becoming a value finder. The old playbook, which worked for years, was all about jumping on hot trends. It was like trying to ride a roller coaster. The new playbook is the complete opposite.
It's more like being a patient gardener, carefully digging into a company's fundamentals to understand its true long-term value.
So, this switch from chasing trends to finding value, it points to what the report says is the single most important skill for this new era. It's not about spotting the next hot thing anymore. It's about deeply, truly understanding valuation. I know, it's a word that gets thrown around all the time, right? And it can feel a little abstract, maybe even intimidating. So, what does the report actually mean when it says you have to master valuation? The report gives a very clear definition, and it's about more than just simple things like PE ratios. True valuation, it says, is about dynamically understanding that core relationship we started with, that constantly shifting balance between the supply of money and the supply of quality assets. Maybe the best way to think about it is this. The old way was trying to perfectly time your ride on a short, choppy market wave. The new way is about understanding the deeper, more powerful force, the tide of capital that's going to lift certain assets over the long, long term. So, to wrap it all up, the report really points to two fundamental truths for this coming era. First, the underlying conditions, those five rivers of capital, are setting the stage for a potential long-term bull market. And second, to actually succeed in that market, you're going to need a new core skill, shifting from chasing short-term trends to patiently finding long-term value. And that leaves us with one final question. The report suggests this new period isn't just a fleeting moment. It could last for years. So the choice every investor has to make is which role they want to play. Are you going to stick with the old playbook and be a trend follower, or will you adapt and become a value finder?